It's time for another edition of the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik. And right now, here's Nick and Becky.
Thanks, RJ. Yeah, today we're going to be talking about the buzzword on the news lately, which is market volatility, and what that actually means, and if it is something to be truly concerned about or not. And Nick, it was always a calming presence in my life.
Oh, wow.
Yeah, I know. It's a big promise. Assures me it's not as bad as it sounds, that it may just be the news hyping it up. Maybe.
Maybe.
Okay.
So I do have an issue with the term market volatility.
Oh, just off
in
the
general,
gate, they're calling
right off
it
the
the
gate,
wrong thing.
I think it's misused. So I think a lot of financial advisors, specifically or financial analysts, when you look on the news, they talk about market volatility only when the market's down.
Oh, so it has a bad rap.
It gets a bad rap.
Because market volatility is negative and positive.
Yeah, it's volatility. It just means change or rate of change. So think in a really good up market, that is technically a volatile market. But volatile has such a negative connotation that I think people only think about it when the markets are kind of in flux, mostly in the negative.
Yeah, it makes you feel unsteady.
Correct. And if I were to tell you, hey, the markets are really volatile right now. And
that cheerful voice, that doesn't work.
It doesn't really work. So it's okay.
Okay.
And obviously, I think it's a thing you should be thinking about. You should know it exists. We'll talk about some of the stuff that hopefully I didn't know I was a calming presence, but something that'll at least educate people about what is actually volatile or not volatile.
Okay, and see through the mass news market.
Yeah, which, let's be honest, TV is there to sell advertising. I don't care what TV channel you're watching. I don't care whatever it is. They're there to get your attention so they can sell advertising.
So they're using the most emotional words.
Yeah,
okay.
They're using the stuff to scare you.
Okay. All right. So tell me about it.
Market volatility conceptually is just the markets moving at a rate of change that is different. Now, we've talked about in previous episodes about how, let's say 30 years ago, the market moving 0.5% in a day felt like a lot for people. And now if we don't move 1% a day or more,
something's wrong.
It's weird, right? So we are getting more 2%, 3%, 4% moves in a day, or days that like start up 3%, go down 1, finish up 2, which is like 6% of movement in a day.
Yeah, feels like a lot.
Feels volatile.
What?
Yeah.
Okay.
So that's really what market volatility is. Now, market volatility has a lot of pros and cons, but I want to focus on the cons today because that's really what people.
Oh, okay. Yeah.
Well, okay.
We're here to lift everybody up with some bad news. Let's focus on the bad side of this.
Not the bad side, but the positives are obvious, right? If the market is just ripping and doing really well, yeah, it could be a high rate of change, but everybody's making money, so big deal.
Okay.
So let's talk about the bad side of market volatility, which is what people are I think, more concerned about.
Yes.
Right? So when the markets are volatile and moving a lot, there's inevitably increased risk, right?
Yes.
High volatility can lead to significant losses in the market over a shorter period of time, or maybe the same amount of losses, but over a shorter period of time.
Okay.
So it feels worse than it actually is.
Yeah, like a big punch instead of 100 little punches.
Yeah.
Okay.
Paper cuts really hurt. Yeah, I think I'd rather take 100 little paper cuts than one
jab. Okay.
Yeah. I think the biggest actual, thing I receive as a financial advisor is the emotional stress from clients, right? So they are stressed out because the moment the market starts to move in a way that feels erratic, it feels like an unknown.
Yeah,
feels
it's insecure, unsecure, one of those.
It's all the secures.
Okay.
Well, lack of all the secures.
Okay.
Yeah.
Okay.
Yeah. It's none of the secures.
Okay.
Yeah, and it's challenging. We always talk about, investing when you're making big money decisions, right? It should be as non-emotional as possible.
Yes.
Right. And people are very emotional when it comes to money.
It's true.
Now, if your money balances are moving like this every day, up and down and fluctuating, if you're emotional about it, it
It's
just
gonna get to you.
amplifies that.
Yeah.
And then I think for people that either because of the emotional stress or because they want to feel like they're being savvy,
Mm-hmm.
I think people overtrade in these kinds of markets. So they're buying and selling more than they should be.
They're reacting
Yeah.
instead of just holding, which we've said
Yeah.
in the long term, if you just hold, the market gets 10% a year
On average.
on average
Over time.
A
A lot of disclosures there.
Okay.
But that's actually great foreshadowing. I have I don't know if it's a fun fact. When they're with me, they're just facts, I think. When you say them, they're really fun. But I have a fact about market performance that I think kind of ties into what you just said. But yeah, over time, the market should average, 10% a year over every, say, 10-year period. But if you're investing for the long haul, keep that in mind, because people will see the market drop 10% and go, oh God, I got to sell. This is the beginning.
It's the worst time to sell.
And it is the worst time to sell. Or we've had some major fluctuations the last few weeks where the market was up a ton one day, and I've had people reach out and go, oh, it's over now. It's time to buy. And and actually we've been doing the opposite. We've been using those opportunities to take profits and free up cash for clients and find maybe a better potential entry point.
Okay.
So the idea there is to don't overthink, right? Let's try to be as functional as possible, not emotional. And I think, like everything else, education is important.
And volatility is normal.
And volatility is normal. So
okay.
What I want to cover is expressing and sharing with people what is normal for volatility.
Okay.
So we can put some actual facts behind this figment.
Charged word.
Yeah, right.
Okay.
And then I want to talk about some behavioral finance ideas, some psychology behind
behavioral finance. Okay. Back to college. All right.
Yeah.
All right.
I tell you, if I wasn't a financial advisor, I don't know if I'd be a therapist, but I would definitely went into psychology. I love it. And I love the mental mindset of it. So we'll talk about that. But let's talk about the numbers first.
Tell me the numbers.
Okay. I've come prepared with numbers.
He's brought notes
on paper.
All right.
Here we go. So I did some research.
Congratulations.
Thank you.
Yeah.
I looked at the S&P 500, which is our major market stock index, over the last 100 years.
Okay.
Okay.
Some good long-term data.
It's great long-term data, right? It's 100 years worth of data. It's most
to
of
be
the
exact.
data. Yeah. And I looked and I sectioned off net market returns year by year, calendar year by year, into chunks. And so I said, okay, let's think about like a low volatility year. So market loses 5% or makes 5%.
Okay, plus or minus 5%.
Plus or minus 5%.
Got it.
And then what I did was I said, okay, now how many years fell in that window? How many years fell where we lost 5 to 15, where we lost 15 to 25, where we lost more than 25?
Okay.
And I went the positive way. I said, years where we make 5 to 15, 15 to 25, and years where we make 25 plus.
All right.
So I've told you that the market averages 10% a year every 10 years over the last 100 years.
Yeah. So I'm thinking most of those numbers should be in the 5 to 15% range, right?
Makes perfect sense.
I mean, that's what the law of averages says.
Hey, and potentially go back to high school or college statistics class.
Mean, median.
Go ahead. Mean, median, and mode.
Mean, median, and mode. That's it. Modian.
Modian. Also a modian.
Okay.
I think that helps when your stomach's upset. Yeah, a modium. Yeah.
Sure.
So I was thinking bell curve. Like maybe like it should start there and kind of dissipate as you go out to the other options. So the most common spot that the market returns fall in those windows that I provided you.
Can I take a guess?
Yes.
Is the positive 10 to 50? Yeah. Oh, sorry. Yes. Well, we've already discussed this. Yeah.
Yeah.
Okay.
Well, it was second.
Oh, what's first?
More than 25% returns.
Positive?
Positive.
So on average, we're above 25, which means to get down to the 10% average, there has to be a chunk that's pretty negative.
Yeah. So I'm going to go through them in order from best to worst.
Okay.
And then I'm going to give you just a fun fact. what I think is fun. I know.
Okay. Exciting.
I'm overusing that term because you always have fun facts. And
I don't think you know the definition of fun.
Yeah,
okay.
I know. I
Go
have
ahead.
facts. So the best group was 25 or more percent return in the S&P. 28 of the 100 years earned more than 25%.
All right.
21 of the years earned 15 to 25%.
These are banger statistics. This
Yeah.
stock market's amazing.
5 to 15, which you picked, was 26 years.
All right. That's 25%, a quarter. Okay.
Right? So if you think about just those years that we make 5 or more percent.
Yeah, that's 3/4 of the
That's
years.
a lot of the years, right? Yeah. I actually didn't do the math, but let's see. It's 49, 69, 75 years. It's literally exactly 3/4.
Look at me.
So if I told you we could go to the casino, play roulette, and pick black or red, but instead of a 50-50 shot, you had a 75% chance of making 5% or more, or a 25% chance of making 5% or losing money, would you ever not bet on the winner?
Wow, that is such a good example. No,
Yeah.
I would always play. If I have
Yeah.
a 75% chance of
And you would understand you would lose
winning.
a quarter of the time,
Yeah. Okay.
but you would win 3/4 of the time.
That feels like a game I want to play.
Yeah. So let's talk
Not
about
that the stock market is a game.
No, but
No.
let's talk about the negatives. So years where we lose 25% or more happened 6 times in 100 years.
Mm-hmm.
Where we lost 15 to 25% was 8 times. And where we lost 5 to 15 was 16. That leaves 23 years in the middle where we lost 5 or made 5. Kind of the insignificant years.
Oh, okay.
But that gives us 75 years where we make 5 or more and 20 years where we lost more. All of this to share. In the last 100 years, only 16% of all of the year's returns fell between 7 and 12%. I figured I took, instead of the average of 10, I said, what I give you a little range of 7 and 12.
So what you're saying is it is usually more motion upwards or down than the law of 10% or the average of 10%. So, which by definition, if we're using this word, makes the market volatile.
Bingo.
We just don't say that when it's up.
Correct. So it's rare, I think statistically we can say, for the market to earn
10%.
10% in a year. It's rare. The market is either going to earn exactly 10%, or I give a range of 7 to 12, right?
Yeah.
But in actuality, we're more likely to earn 20+% in a year or lose 5% or more, but it averages out to 10. So I think it's important for people to realize that if you were talking about long-term investing for retirement or even in retirement, because I have a lot of clients and people that I talk to that say, hey, I'm 65, I'm retired now. I can't play the long game. I don't have that time.
That makes sense.
It sort of makes sense. It makes sense for money that you need to live on the next 5 to 7 years. But God willing, that person lives more than 10 years, maybe has a 20 or 25-year retirement. Well, the money that you need in the last 10 or 15 years hasn't
been made yet.
Bingo. It's going to be invested more than 10 years. It hasn't been made yet. So why not take advantage of these numbers and make sure that a chunk of the money is set to make money over time for you.
And if you do proper planning, then when you're inevitably at the end, of your life, you have enough money already and the market doesn't.
Then the market, and you start to shift long-term money into medium-term money.
Or whatever.
Correct.
Ooh, look at me, vocab words. I know.
Man, you are crushing
It's like
it
I
today.
took finance classes at some point.
Yeah, it's like you have an MBA.
Yeah. Okay.
So I think that's the data, right? So people don't think, they think I'm supposed to earn 7%. I'm supposed to earn 10%.
So they panic when it's anything less than that.
Less than that. They
worry. They don't celebrate when it's more than that.
Exactly.
Appropriately.
So and you know what that's called? That actually, by the way, segues perfectly into the behavioral finance stuff I want to talk about. So what you just described is loss aversion.
Loss aversion.
Loss aversion. It's where the pain of losing money, it affects people significantly more than the pleasure they get from making money.
Okay.
So I don't know if you've ever heard this, but I've shared this as an analogy where people will not walk across the street to get something that they like to pick fruit or something from a stand across the street, but they will run across fire to get away from something they're scared of.
Oh, more motivated by
By fear. Yeah.
I mean, that feels natural for a human. Okay.
And that is normal human instinct, but it messes with you when you're investing. Because if you get these volatile periods, where I would argue the market's always volatile, but where you get these periods where the market's down, the fear of
takes over.
Yeah, it takes over, and you start to make bad decisions.
This is loss aversion?
Loss aversion, yeah.
Okay.
Yeah.
So it's a normal reaction. However, when we're dealing with investing in finance, we have to be non-emotional, unemotional, and look at the facts and just say this is part of normal market patterns.
Correct.
I mean, there has the potential to be bad years, right? But
oh, yeah, we've looked at the numbers. There are always going to be bad years. In fact, 3 out of 10 years, the market will be negative.
Okay.
3 out of every 10. And I believe this statistic still holds that if you then break that down into quarters, like 3 months at a time, almost 40% of all calendar quarters are negative. So yeah, if you look at, so you make all of your money by just the difference between the 60% versus that 40%. Because the 60%, when it's...
So you just got to zoom out, way out.
Bingo. You really have to think about, is this money I need this year, next year, 5 years from now, 10 years plus?
Okay. That's interesting.
Yeah. So loss aversion is a big one. That's really where I find myself playing therapist very often, marriage counselor.
Oh.
Another behavioral finance thing that I think comes up a lot, and I kind of referenced it earlier, is what I call overconfidence bias. It's where people think, and this doesn't just go for finance, people think they know more than they know.
Yeah. Well, I know I've met a few guys like that.
Oh.
For sure.
Is this dating history? What is this? Is this what we're talking about? Is this life before Nick? What are we?
Average guy definitely is very confident and cocky. Yeah.
Potentially overconfident?
Yeah.
But like, imagine if I came home and I'm the first one to admit, look, I know a lot about this, but I don't know anything about like fixing my own car.
Yeah.
Right? That's not my expertise. But imagine you came home and I had the hood popped. I had the tools out. I was like, I took a piece out of the car. I don't even... Carburetor, maybe that's a term, right? I took that out of the car. Okay. Like, what are you doing? I'm like, oh, I'm just replacing the shenanigans valve. You know, I don't know. You'd be like, why don't we call a mechanic?
Yes.
So why is it that when people are planning for their retirement and dealing with some of their biggest amounts of money, their financial future, do they say, oh, you know what? I know better. It's a good time to enter or exit the market. It's
probably Google's fault because anyone can research now on Google.
It is. It's also, I would think, something I call herding bias.
Gosh, you're just naming terms now, left and right. Okay.
Yeah.
Herding.
Because,
like as in pain, H-U-R-T.
No, herding like
animals. Like herd mentality.
Herd mentality. Yeah.
Oh, yeah.
Because
that's the thing.
You just said people, you can go on Google and just find information. You could chat GPT things. Right? And say, help me. Now, ChatGPT, I don't think gives investment advice, right? But like, you could at least get information. Herding is the other problem. Social media. It used to be.
Oh yeah.
You used to be able to go to your office.
We're all victims to the algorithm now.
Yes, Becky. Hey, how do you allocate your 401k? I guess I'll do it the same. Like you're an expert, right?
Well, I know things. No.
But now anybody with a camera, I mean, people are watching this, but you know, I'm a licensed professional. But now anybody with a phone could start a channel and say, this is a scam, this is a problem, and get you worked up, get you emotional, and have you making decisions that affect you and your future.
Yeah.
And have no impact on the person giving the advice.
Yeah. So really it's another opportunity to take a step back and see where you're getting that information and maybe see if there's a more credible source, aka a licensed financial advisor.
Yeah. And
it makes sense.
And I think if you were on social media, you tell me, if you heard something on there, even from somebody credible, that you think is credible, like they might not be a financial advisor, but they seem like a reasonable human being.
Yeah, it sticks in your brain. So you really have to take a moment to think about the source.
Yeah. So. It's kind of like I always think about when athletes promote like
vitamins.
Vitamins or drink Sprite, drink this. Be like, oh, well, LeBron James said to do it, so I must do it. I'm like, really? Like, what?
Yeah. No, that makes sense.
Yeah.
All right. So Since I had very little to contribute to this conversation, I did bring a little Quizlet in the form of facts for you. We are going to discuss, you have to tell me if you think it's more or less volatile than the average market. And so...
Oh, is this like a Jeopardy thing?
Jeopardy category.
Okay.
More or less volatile?
More than less than.
So...
Right. By the way, time to make your husband look foolish. And go.
Let's just say volatile is like 20%, 25%. So things that change more than 25% or less, or like stay less than 5%. So more or less volatile.
Okay.
Is that making sense?
Sure.
These are all kind of easy giveaways. Bitcoin.
Oh, Bitcoin, I know.
Yeah.
Bitcoin, I know, is more volatile than the average market.
Yeah. It has exceeded more than 100% change in price in a year.
In a year.
Yeah.
And averages, by the way, I think I know this statistic, almost 200% gains average on year, but it's like...
But it goes way up and then way down. Okay. Yeah. In 2013, it gained 5,500% in a year.
Wow.
But it also suffers over 20% losses regularly. Annually. Yeah.
Okay.
So...
super volatile. Score one for Nick. There we go.
Well, this one might... Okay, so more or less are the same for a 50-inch television.
Ooh, the price like a 50-inch television over 20 years?
We're going to say 10 years.
Less?
It averages almost the same. It is like 12%, but down. It trends less because of a improvement in technology and everything like that. So on average, a 50-inch television loses 12% in price a year from 2015. So it costs like $1,000. Now it costs like $300. There was a year during COVID that it went up because of supply chain, whatever that means.
Just wait. I don't think we make TVs in the United States. We can't talk about tariffs on this episode, but
yeah. All right. Toasters. The price of a toaster.
Okay, first of all, they used to give toasters away at the bank. Right? So
this is like when my parents used to get a free steak knife every time they filled up with their tank of gas at a mobile station. Isn't that weird? Okay, they used to give toasters away at the bank. But anyway, go ahead.
They used to, I feel like. You open an account, you get a toaster. I think toasters have... I don't know what they used to cost back in the day when they first came out, but they're not expensive now. I would say less volatile.
Less volatile. In 1974, the price of a toaster was $15.
Okay.
And now, in 2024, the price is $30 to $60.
Okay. So it's
I guess there's swanky toasters out there. Yeah, it's about 5% annually.
Okay.
It increases in price. And the lowest one I could find, well,
you're
there's
shopping
kind
for
of
toasters
two.
Now?
No, this is like a product that you can buy. I do need a toaster, though. Is blankets. Isn't that the most random category ever?
Well, I can confidently tell you.
Yeah.
I have not purchased a blanket, like a comforter. You bought my last comforter when we were dating. Remember you bought it for me?
Well,
because I was I was living that bachelor life.
Yeah.
I have no idea what a blanket even costs.
Okay.
I'm at such a loss because without you, I wouldn't own blankets.
It's so cold. Okay. They have almost no change. It's 2% a year. The cost of blankets goes up. Part of that is because what they're attributing to volatility, causes in volatility, of course, is technological advancements, which is why the prices of TVs drop, supply chains and market competition. So what you can see with blankets specifically is there is no technology change, the same amount of market competition. You know what I mean? Like that's just kind of stays the same. Yeah. So you'll find more volatility in technology products like TVs and Bitcoin and stuff like that than anything else. So, and toasters, I mean, I feel like they kind of just work the same. So
yeah, I mean, if you're talking about like the 2 slices in, press the button down toaster, not like a toaster oven, not an air fryer.
Not the one at the hotels that like sends it through.
I want one of those.
Okay.
I want to slice my bagel and watch it just come around and go out the bottom.
So if you're looking to stay consistent, toasters and blankets, everybody.
You just like to stay warm and fed.
It's true.
Yeah.
All right, but here's your bonus thing.
Oh, I get a bonus thing.
We're going to bring in current events.
Okay.
Right, but we're going to wrap up after this. But so we are going to get a new pope.
We are going to get a new pope.
In years where we have had a new pope name, is there more, less, or no market changes?
Market changes based on pope selection.
Yep.
We have better markets on average. This is totally a guess. I have no idea.
There is no statistical impact on the stock market on years that we get new popes.
I got baited.
Everybody. So,
I got baited.
I mean, it's just average years. But basically, the change in a religious leader, even the worldwide most powerful religious leader, does not statistically impact the S&P 500. So,
you know, it's fun. We talked about that pre-election about who's in office and if it matters, and we find out that there's really statistically no difference.
Yeah.
Interesting to see I never thought about it from a religious perspective. But yeah, I mean, and
so they signal stability and boost soft indicators like public trust or social optimism, but those don't normally impact the market in any significant way.
All right.
So whoever the new pope is, you're important, but not for my retirement.
Not for my money.
Yeah.
Well, I will share this on our way out.
Okay.
I know what the word conclave means, thanks to you.
Yep.
We went
keeping you cultured, Dave.
Yeah. So now that this happened, I know what's happening because we saw the movie.
Yeah, it's a great movie. So
on that note, couple little misnomers and couple little facts about market volatility, and you should not be scared of it. In summary,
okay,
volatility is a thing. It always has been, always will be.
Mm-hmm.
We will probably see more larger movements as time goes on because of technology, the amount of money in the market, and all of that. But this should not scare people. This is a normal thing that happens, and over time, you see that it does benefit us more than it hurts us.
Okay.
So
it's positive and a negative thing.
So positive out of a negative. I don't know. I guess it's negative in those short periods of time too. Yeah.
Okay.
So for more information, you can find us on our website, sunrisewealthadvisors.com. Social media, we're on LinkedIn, Facebook, Instagram, X. I think that's all of them.
Yeah.
We're setting up smoke signals. We're just sending stuff out.
No, that's just for the Pope.
Oh, that's just... Hey, I see what you did there. That was pretty good. If you want any information, we have newsletters. We have stuff we send out. We've also been doing short videos, like little 2-minute videos on updates. If you want any of that, just go to the website. There's a little information box there. Just leave your name and email or however you want to be contacted. We're happy to get it out to you. So for my wonderful wife, Becky, and me in our new studio, thank you for listening, and we'll catch you next time.
Thanks, Nick. Looking forward to your next podcast, and thank you for listening to today's Can I Retire Now podcast. Until next time, for Nick and Becky, I'm RJ Malik.